Alright, so following a short break after the midterm exam, it's time to get back into new material. This is Lecture 9. It's on Chapter 9, which is stocks. I basically only have a week and a half left in this short semester. It's only 7-week semester, so we'll have one more week of new material, and then you'll take another exam, your final. This we're going to cover 9, 10, and 11. So we're not going to cover everything that was on your original schedule. 9's on stocks, 10's on cost of capital, 11's on capital budgeting, and we won't cover everything out of those chapters either. But you'll have 3 lectures for those 3 chapters posted today or tomorrow, and then you'll have an assignment, a couple assignments due by next Wednesday, so a week from today. Alright, so let's start with Chapter 9 on stocks. The only thing we're really going to cover out of this chapter is this one model. It's called the constant dividend growth model. It's got some other names like the Gordon growth model, the constant growth perpetuity. But it's a real basic model for pricing stock based off its dividend stream. So you can add layers of complexity to this model if you want to deal with more complex cash flow streams. But this model really only works best for large, fully developed companies that pay a fairly consistent dividend that grows at a constant rate. If it's a new company that doesn't pay dividends, or a company that kind of pays sporadic dividends, just this basic model is not going to work very well. But like I said, it can be adjusted for those other types of companies as well. This is really just a starting point for pricing stock, and then if you want, you can add layers of complexity. Basic model looks like this. The price of a stock should be equal to its dividend it pays next period. So P sub 0 means price today, D sub 1 means dividend next period. The math just works out correctly. You have to make sure you use next period's dividend, not the D0 would be the dividend that was just paid. This needs to be the next period's dividend. You divide that by R, which is your required return on the stock, minus G, which is the growth rate of dividends. To see why this formula works, we can rearrange it for R, and we'll actually use this formula in both forms, solving for price and solving for rate. If you look at it solved for rate, though, you can really see why this formula works. It shows that the required return is a function of 2 things: the dividend yield, or what we call the current yield, and the growth rate. The growth rate in the constant growth dividend model is the growth rate of dividends. It's also the growth rate of the stock price. It means it's capital gains. Everything grows at the same rate with this model, which means earnings per share grow at the same rate, the book value of the firm's equity grows at the same rate. They all grow at G, is the assumption behind this model. So it's capital gains, it's growth in dividends. Basically, if you were to take capital gains and add in the dividend yield, that would be, you can break any, we've done this before earlier with bonds, where you can break any investments returned up into those 2 categories, current yield plus capital gains. Well, that's all we've done here. And then we rearranged and solved for price, and so then putting in R, you can get your price back out. So let's do some examples here. Example 1, over the last year, Coca-Cola Company paid a total of $1 in dividends per share. Long-run dividend growth of Coke has been 10.4% per year. If you require 11% return, what's the maximum you should pay for the stock? What about a 12? What about a 13% return? So it's just a straight application of the formulas. You're actually given D0 in this case. This is the dividend that was just paid. So I'll have to make a slight adjustment to the formula to change that D0 into D1. Other than that, we're just going to plug in our required return. R is either 11, 12, or 13, and G is going to be 10.4%. So if I scroll down, I've done that here. First off, this is the original formula I showed you here. D1 divided by R minus G. If you're given D0, which is the dividend just paid, you just have to multiply that by 1 plus the growth rate to get dividend 1 year in the future. So this is a minor adjustment to the Gordon growth model to deal with an input of last period's dividend instead of next period's dividend, the dividend that was just paid. So for starters, that's an adjustment, and then the only difference between these 3 is which required return I put in. On the top one I put in 11% for R, and the middle one I put 12, and the bottom one I put 13, because that's what the problem asks for. We basically want to see if I adjust my required return, what happens to my price. Everything else is the same. So D0 is $1 for all of them, because that's the dividend that was just paid. 1 plus the growth rate would be 1 plus 10.4% in all those cases. If you multiply $1 times 1.104, you're going to get 1.104. And so simplifying, the numerator is 1.104 in all three cases. The denominator changes not because the growth rate changes, but because R changes. So in each case, you take your R, subtract out the same G, which is 10.4% in each time, and you either get 0.6%, 1.6%, or 2.6%, and then go ahead and divide those two numbers, and you get three different prices here. So if you plug in, say, 11% required return, that corresponds to $184 stock price. 12, 69, 13, 42. First thing to note here is fairly small changes in required return can lead to really large changes in stock prices. Stock prices have high duration, which I think we talked about briefly back in the bond chapter, but it just measures the sensitivity of the prices change to changes in interest rates. Due to the nature of stock having a growing dividend, so they're paying out relatively little in the near future and they're paying out a lot down the road, that causes their duration to be high. If you which we won't be calculating durations for stocks, but it's not that hard to do. But it's just beyond the scope of the course. But if you were to calculate, they tend to be high on the order of 20, 30, 40, even up to 100. Meaning that if you had a duration of 100, that's a 1% change in rates leads to a 100% change in continuously compounded rates of the price. So in other words, just because of the nature of the cash flow streams, of growing cash flow streams of stocks, they tend to be very, very volatile. Doesn't necessarily mean that stock markets are inefficient or out of whack or don't make sense. You tend to get really large swings in stock markets. It's just due to the pricing mechanics of the way present values work. When you have all your cash flows way in the future, you're going to get very big price swings for small changes in interest rates. Also note, you get the typical relationship that if interest rates go up, prices go down, just like you would with bonds or any other investment. So we go from 11 up to 13, the price falls from 184 down to 42. Let's do another example. Over the last year, Coca-Cola paid a total of $1 in dividends, long-run dividends 10.4%, so I didn't change anything there. But the second half of the problem is different. I said they recently, their share price traded for $37.56. Excuse me, based on the Gordon growth model, what required return is the market using? So I flipped the problem around here. Instead of solving for price, we're going to put price in and solve for required return. So we're going to use this form of the model. R equals D1 over price plus the growth rate. Again, we have to do a slight adjustment because we're dealing with D0, not D1. So we need to gross that up 1 year's growth rate first. But this is the same formula I showed you up on the first page. And then I've plugged in the necessary inputs. $1 was dividend just paid. We'll do 1 plus the growth rate. That's 1 plus 10.4%. We'll divide by price. And then you need to add back the growth rate, because this whole thing over here is called the dividend yield. This is the dividend you're going to receive next period divided by what you're paying for it. Well, that comes out to 2.9%. So based your income you're receiving, you're getting 2.9 cents on the dollar of what you pay. But you're also going to get 10.4% capital gains, we would assume, over the long run. If dividends are growing at 10.4, we would expect the stock price to grow at 10.4. And so in total, you're going to get 13.3%. That's basically it. Those are your two problems you'll have to do out of this chapter. There's other models, like the PE model and things like that, which I'm not going to touch on. Feel free to read your textbook if you're interested in it. Send me any questions in an email and I can help you, but you won't. Just for examination purposes, we're going to stick with this one basic model. Just to finish the lecture and wrap up and kind of summarize what we just looked at, I wanted to show you kind of, if you wanted to do this in practice, how you would go about doing it. And so what I have here is the dividend stream for Coca-Cola going back to the beginning of the 70s. This is in a regular scale. It's much easier to work with logarithmic scales because things don't grow exponentially, they grow in a straight line. So for starters, I'm going to change this into a logarithmic scale, and so it'll grow at a straight line. So the first thing you would do if you were doing this in practice is we need to figure out, well, how fast are dividends growing? So I fit this red line. It's just a straight line fit to it. And this is just a real basic way, but if you find the slope of that line, it's 10.42% a year, which is, on average, since the 70s, how fast the dividends of Coca-Cola have been growing. Now, there's much more complicated models. There's things called autoregressive moving averages, Garch models, things like that. If you want to get, because you can notice it doesn't always grow exactly at 10.42, especially if you just go back over maybe the last 15 years, it maybe has been growing a little less. And so maybe you don't want to use 10.42, you want to use slightly less to get a more conservative estimate. All I did in those two prior was just use the long run dividend growth. But then given that dividend growth, we can go over here and calculate some expected returns on Coke over that time. I have a second chart here which has the dividend yield over that time period. All I've done is, if you look up in my cells up here, I've divided the dividend per year by the price per year in each case. Then you can add in, sorry, let me get this chart out of here real quick. Add in your growth rate. This is just the Gordon growth model. It's the dividend yield plus my 10.42% a year. And then this red line up here, it's the dividend yield plus my 10.42%. That should be my Gordon growth model estimate of expected return. And then what would you do with that? Well, we could take it and compare it to some benchmark like U.S. Treasury rates, for example. And so you could say, well, I could either go out and invest in a long-term U.S. Treasury, or I could invest in Coke. Which one's going to get me a higher return? Well, obviously Coke is over that entire time period if you believe this simple model. But you then have to ask the question, am I getting enough return per risk? And you might have to do beta calculations and things like that to figure all that out. You could also compare it, maybe a better benchmark would be B-rated corporate bonds. Whatever benchmark you want, you can see what return, estimated return you're going to get on Coke versus your benchmark. And then lastly, I wanted to show you that expected return versus Coke stock price, so you can kind of see the relationship between the two. Let me put this on the secondary axis. So we have on the left axis is the red line, that's our Gordon growth model expected return on Coca-Cola. And then on the that's the left axis. On the right axis is the blue line, and that's the natural log. Again, I put it into a log scale of Coca-Cola stock price. You can see the inverse relationship. So whenever the stock price tanks down like it did in '75, the expected return goes way up, and vice versa. Coke did really well in the 80s and 90s. Well, as its price went way up, each marginal investor that was buying in at a lower expected return. So the stock price has done better in the past, but that means it's not going to do as good in the future when you see that red line go down. Alright, I'm going to go ahead and end this lecture now. I'm going to put up an assignment where you have to do a little bit with the Gordon growth model, and then we'll move on to chapter 10 on cost of capital. Thanks.